What if I told you the single worst performing stock of 2025, a company down nearly 70%, is statistically the smartest buy you can make for January 2026? It sounds crazy, but it is a phenomenon Wall Street has exploited for decades called the January effect. Here is the secret they don't want retail investors to notice. In December, fund managers sell their biggest losers to harvest tax losses. They dump perfectly good companies just to lower their tax bills before the year ends. But the second the calendar flips to January, that artificial selling pressure vanishes. The buyers rush back in, and those loser stocks slingshot higher. I've analyzed the carnage of 2025 to find the 5 most unfairly beaten down stocks that are primed to explode in Q1 2026. Let's start with the fallen giant. If you looked at the S&P 500 performance map for 2025, this was the biggest red blemish on the board. The Trade Desk, ticker symbol TTD. This ad tech leader used to be the darling of Wall Street. But in 2025, fear over ad spending slowdowns caused a massive sell-off, pushing the stock down roughly 70% from its highs. But here is why this is the ultimate January play. The business isn't broken. They are still the undisputed leader in open internet advertising. The selling we saw in December wasn't about fundamentals. It was institutional capitulation. Hedge funds were dumping TTD just to get the loss on their books before December 31st. That pressure ends today. If market sentiment shifts even slightly back to growth, TTD has the most room to run. Next up, we have a stock that was thrown out with the bathwater during the mid-2025 volatility. GLBE Online, ticker GLBE. This cross-border e-commerce player is down about 27% over the last year because investors got scared of a global recession and dumped anything related to retail. But look closer at the data. Analysts are projecting earnings growth of over 177% in 2026. This is a classic mismatch. The price is acting like the company is dying, but the earnings are about to skyrocket. This is a baby tech stock that got crushed by macro fear. When the tax loss selling ends, this is exactly the type of mid-cap stock that outperforms the slow-moving giants. Now, before I show you the most speculative, high-risk rocket on this list, I need to give you a warning. 2025 was the year of the AI divergence. Just having AI in your name doesn't work anymore because the easy money is gone. 2026 is going to be a stock picker's market where execution matters more than hype. I want to know your strategy for the new year. Are you buying the dip on these beaten down names, or are you sitting in cash waiting for a crash? Let me know in the comments below. Okay, are you ready for some risk? This is stock number 3, Altimmune, ticker ALT. This is a biotech play, down 46% year to date. The sector got hammered in 2025, and investors lost patience waiting for trial results. But Altimmune is sitting on a potential gold mine with their weight loss and liver disease drugs. The catalyst here is massive. Major phase 3 trials are kicking off in 2026. If the data is good, this stock doesn't just go up 10%, it could double or triple overnight. If the data is bad, it goes to 0. Do not put your mortgage on this, but as a January effect play, it's perfect. It has been shorted and sold to death in 2025, meaning any positive news in January will trigger a massive short squeeze. Let's move to something with real revenue and a unique angle. Stock number 4 is Samsara, ticker IoT. While everyone was obsessed with ChatGPT and text-based AI in 2025, Samsara was quietly building the brain for the physical world. They use AI to track trucking fleets, safety, and logistics. The stock is down 17%, mostly because it's not a sexy consumer AI play. But Wall Street is waking up to the fact that industrial companies need this tech to save money. Samsara is rolling out new AI features in Q1 2026, making this a high-quality company currently on sale. Finally, we have the stock everyone loves to hate. The boomer of the fintech world, PayPal, ticker PYPL. PayPal spent most of 2025 being ignored as investors chase shiny new objects, leaving PayPal for dead and calling it a value trap. But look at the valuation. It is priced for 0 growth, yet they still dominate online payments. With the uncertainty of 2026, money is going to rotate back to safety and cash flow. PayPal is the ultimate efficiency play. The tax loss harvesting on this one has been brutal for 2 years straight. A reversion to the mean in January could easily net you a quick 15% to 20% gain as institutions rotate back into value. Remember, the January effect isn't magic. It is simply psychology and tax law. These 5 stocks were beaten down in 2025 for tax reasons, not because they are broken companies, which makes the spring of 2026 loaded with potential energy. I am actually buying one of these stocks heavily tomorrow morning for my personal account. If you want to see exactly which one it is and get my full portfolio breakdown, make sure you subscribe and turn on the bell notification. I'll be posting that update next week. Good luck in the markets and Happy New Year.